Yes. Yeah.
Okay, Gaurav. So earlier we were discussing about how to choose good quality mutual funds. Now, in continuation, I have prepared a intriguing quiz
Okay.
about investing. This quiz shows the power of long-term investing and compounding. So let's see. It is supposed to be a fun quiz. So let's participate. I'll again share my screen and show you how about this. We'll participate in this quiz. Okay. Do you see
Yep.
the screen?
Yes, yeah.
So the first question, it would be better to have $10,000 per day for 30 days or 1 cent that doubles in value for every day for 30 days. Which one you
Second,
think?
uh, second option logically, but
Why?
10,000. That
10,000
every time.
30 days makes it 3 lakh,
Yeah,
300,000. And we are
and
starting with 1 cent.
one will twice. Then it will get twice every day now. By if we
Yeah,
can
double
select
every
second
day.
option. So I think
Are you
second
sure
option
about
will
second
be.
option?
Yeah.
Maybe you end up with few dollars.
Uh, I'm not sure about that total amount, how much we will get, but logically speaking, second will be good if your amount will get
Okay,
twice
let
every
me tell
day.
you, I'm using a calculator.
Mm.
So if I double my money, for 30 times continuously, I end up getting, hold your breath, I end up getting 53 lakhs 68,709 dollars. If I start with 1 cent and keep on doubling it 30 times,
Yeah.
my calculator says we we end up getting 53 lakhs 68,000. So that's about more than 5 million. So
Yes.
we get more than 5 million if we keep on doubling it every year. And we reach only 3 lakhs or 0.3 million if we get $10,000 per day. So it shows three things. It shows the power of compounding and also the power of patience. That if you are playing the waiting game, if you are having a slow start but accumulating with $10,000 per day, they are not growing, they are keeping up the same. So you can compare that with something like salaries, but somebody who is into the growing business. So that is the power of growth. And this is also the reason why growth companies, the company which are growing very fast, are actually priced much higher than their earnings. They have a very high PE ratio. So that will come again, but again. So this is very interesting, the power of compounding. Now I tell you what, just imagine a situation, these 30 days are not 30 days, but 30 years.
Okay.
These 30 days are not, these 30 days are actually 30 years. And you are actually able to, let's say, double your money every 3 years
Okay.
through power of investing, trading, etc. You are able to. So if you starting at around 24 years of age, just imagine by the time you are my age or maybe around 50 years of age, you could actually be a billionaire, rupee billionaire you could be, if you are able to consistently compound your money. So that is the power of compounding. So we move on to next question. Think you could find a totally risk-free investment? No, not possible.
No, no.
Yes, if I tried hard enough.
I
Think you
don't
could
think
find
so.
it?
Yeah. Even government fund are also not safe. Anything can happen, so I don't think it's possible.
Actually, yeah, I agree. I have given a long thought about it. I don't think if I can find it totally risk-free. There's no safety of life even,
Yeah,
there's no
yeah,
safety of life. So I believe finding something totally risk-free is not the right idea. Minimizing risk, controlling risk, managing risk is the better way to deal with things. Finding something totally, like somebody investing in government securities or somebody investing in state government securities, etc. They might be the safest. they might be the safest, but if anybody can say they are totally zero risk, I don't agree.
Yeah.
In last 10-15 years, we have seen Venezuela, we have seen Pakistan, we have seen Sri Lanka. I personally, I don't know how things have ultimately finished with them, but Argentina, Greece, and many such countries, and so many countries in sub-Saharan Africa are so unstable, etc. So, investing in like sovereign securities in all these countries has been a negative impact. So, even Dubai once did sovereign default in 2008. So, and there's nothing risk free, totally risk free. Even America has it is American dollar, which is the benchmark for all international transaction. Even that is not 100% risk free. That USA is also highly in debt. So nothing is totally risk free. Third question is, which is a long term investment vehicle, a
Which
certificate
is
or
not
deposit, bonds?
not a long.
Tell me.
Certificate of deposit is not a long term because it is issued by government for a shorter period of time.
Yeah, it has a fixed maturity, which is of smaller duration. Mutual fund can go on for a longer period of time for several
Yes.
years, and so is bonds, which are usually more dependable. Stocks or bonds?
Bonds, because bonds are issued by government or any companies.
No, bonds are more dependable because their price do not fluctuate so
Okay.
widely. Although it may not be so always, but bonds are considered to be more reliable because they do not have that kind of huge price swings that we can expect in a stock, in a
Yeah.
particular stocks or in stock markets. And what is usually the safest investment? Treasury bills, common stock, mutual funds. Which is the safest?
Treasury bills, because it is issued
Treasury
by
bills
government.
because they are issued by the central governments on behalf of the governments. When are you taxed on your investment? When you buy them, when you sell them, when they increase in value?
I think when they increase in value, because you
No,
have
when
to
you
pay
sell
tax.
them. And when you sell
Okay.
them, if they increase in value, your portfolio keeps on increasing. There is no tax liability until you sell them.
Okay.
Okay. Money market funds are invested in stocks, treasury bills. Where do money
Treasury
market
bills.
funds invest?
Treasury
They
bills.
in treasury bills. We discussed about this when
Yeah.
we discussed liquid Bs, right? Rising interest rates are good for bond returns. Rising interest rates are good for bond returns. Is it true or false?
True.
No, rising interest rate are actually is bad for bond returns. Why? Because bonds are issued at a certain interest rate. Say
Okay.
somebody issued a 1000 rupees coupon bond at 8%. So that means that person will be getting 80 rupees as interest. Okay. Now the bond rate, actual market prevailing price of the bond rate has gone to 11%. So now outside I am getting 11 rupees on my 100 rupees invested. Here this bond gives me 8 rupees for my 100 rupees invested.
Yes.
So is it a good for a is it a good thing for bondholder or bad
No.
thing?
Bad thing.
It's not a good thing. It's a bad thing because he is losing out on that 3 rupees that he would have got if he was not holding those bonds. Okay. So it is not a good thing when the interest rates are rising. But when interest rates are falling, let's say prevailing market rate is gone down to 5% and you are holding 8% interest coupon bond. So in that case, you will feel the okay, you have got some kind of lottery that okay, others are actually investing 1600 rupees, around 1600 rupees, or maybe around, wait a second, around 1500 to 50 rupees to get a gain of 8 rupees or 80 rupees, and you are getting that 80 rupees on just your 1000 investment. So your bonds value will appreciate. There is still lot of discussion, or there can be a separate class regarding this relationship between the coupon rate, market interest rate, the option, this not options, the bond prices and all. So how the bond prices are affected by the prevailing interest rate, etc. So there can be a long class, or I can give you a good reference to a particular class where you can learn about relationship between prevailing interest rate and bond prices. Okay.
Okay.
Rising interest, yeah. A stocks bid is the price the market is offering to. The stocks bid is the price the market is offering to buy a stock from me or sell a stock from me.
Uh,
Bid.
Bid is for buy a stock.
Bid is for buying. Bid and ask.
Yes.
Bid is when you are placing a bid, it is for buying. For selling, it is the asking price.
Yes.
So generally, bid we place on the left and asking on the right. So buyer price is on the left and the seller's price is on the right, which is not a benefit of mutual fund.
I have to pay fees.
Yeah, that is not the benefit. The benefits are you have less effort and less volatile. Mutual funds obviously are generally a group of companies.
Yes.
Mutual investing in one particular company is not mutual fund. I did discuss about SEBI rules where they limit the exposure of mutual fund schemes based on individual script and a group company, etc. So we did discuss this. In the mutual fund world, S&P stand for Standards and Poor's. It's a name of company, not stupid and poor. Okay. So this was just a small quiz. And there's another thing I wanted to share with you regarding this Warren Buffett. You must have heard of Warren Buffett, right?
Yes, they are one of the greatest investors of the time.
Yeah. Always do hear about beautiful girls and rich people.
Yeah.
They can both motivate young guys like you, right? So I'll share another screen. So Warren Buffett is a rich man, we all know, but Warren Buffett should impress. Should impress you. Should know leave a mark on you, not because he is very rich person, but because of his wit, his thought process. Like there's so much to learn from him. Like look at the first quote itself: "The public opinion poll is no substitute for thought." You must have seen people asking everybody, "What is your opinion? तुम्हें कैसा लग रहा है? मैं ये चीज खरीदना चाह रहा हूँ, तुम्हारे क्या विचार है?" They asking 100 people about your decision is not substitute for your thought. I firmly believe in this quote. So these are very interesting quotes. I have these were collected by me way back, I think around 14-15 years ago. So I'll share this document with you so you can read it and enjoy it.
Okay.
I'll share this document for you. So there is one topic that is left about investing, and that is about diversification of risk.
Okay.
How to diversify our risk that we put into our investing or personal finance, etc. So we'll discuss it separately. We'll close it for the time being, and we'll start again with the diversification of risk. Okay. Take care.
Okay.